So, the fractional reserve banking is a policy set by the Federal Reserve, our central bank. It is the practice where banks, local banks, are required to keep a certain percent of all deposits on hand in-house in cash. The rest of it can be loaned out to people for houses, for college, for starting up businesses, what we discussed last class. Currently, for most banks, the reserve requirement is 10%, which means 10% of every deposit has to be left in the bank in cash. Again, that is so banks can guarantee to have enough cash on hand to grant clients withdrawals. Obviously, if there was a bank run, that wouldn't be enough, but that's where the Federal Reserve would then loan the bank cash to cover the withdrawals, hopefully taking away the panic. And remember, we are insured by the FDIC, money up to $250,000. So again, if Sheila deposited $10, the bank would be required to keep $1 on hand. The other $9 would be loaned out to people. Here's another example of it. So again, with a $100 deposit, 90%, so $90 is loaned out, $10 is left in the bank as a reserve. So what does the Federal Reserve require banks to do to keep a fraction of the money in reserve? The rest of the money is loaned out to customers. Go ahead and do those for you. So for example, if the reserve requirement is 25%, that means that they would need to keep $25 in cash on hand, loan out the 75%. If it's 15%, you keep $15 and you loan out $85. Now, you might think, who cares? Well, this is important because the banks typically want lower reserve requirements. Banks make money off of loans, people paying interest on loans. So the more money banks have available to loan out, the more money they can potentially make. Banks want lower requirements. Right now it's 10%. That might change because in times of recession, when people are nervous, when people might be withdrawing more money from the banks, they will raise the reserve requirement to maybe 15 to 20%. But when things are booming, when there's no real worry about banks not having enough money to cover withdrawals, typically reserve requirements are kept low, around 10%. That's important because you're going to have a question about that in the challenge questions at the end of this presentation. So at this point, hopefully you watched the Federal Reserve videos. At this point, we're going to start talking about the Federal Reserve, who I alluded to with the fractional banking. So the question is, what is the Federal Reserve? Well, that's the central bank of the United States. It's the main authority on money. It's not a part of the government. The government can kind of keep an eye on them, but the president can appoint the new Federal Reserve chair. But it is a private bank, and it is in charge of all other banks in the United States. Imagine we didn't have one currency for the whole nation. So in other words, states would have their own currency. You'd have Indiana bucks and Kentucky dollars and whatever. Or banks had their own currency. So you had BMO Harris bucks and PNC dollars or whatever. Imagine or think, what would that be like? What were some difficulties that would come across because of that? And that's exactly what it was like before 1913. Now, we had several panics in the history of the nation. We talked about one of them with Rockefeller when the railroad companies started failing. A big one was in 1907 when several very large private banks, because of poor practices, one of them called speculation, and I can tell you more about that if you want, just email me. But they started failing, private banks. And that trickled down to smaller banks who then got money from them, borrowed money from them. And so people found that banks that had their money in it, which was not insured yet, the FDIC was not until the Great Depression, they lost their savings. And that caused a panic. People heard about this, so they went to their banks and started demanding all of their money out of it. That's called a bank run. Banks did not have enough money to cover all the withdrawals, so they failed. They closed. And this really had the chance to spread like wildfire to the rest of the nation and cause a complete collapse. Thankfully, J.P. Morgan, who you read a little bit about in the Gilded Age, came along, and he basically loaned or granted money to several of these large banks, enough large banks to keep the whole system from collapsing. Now, crisis was averted. A lot of pain happened, but crisis was averted. However, it was crystal clear we needed a central authority to regulate banks in some sense. So in 1913, President Woodrow Wilson, one of the progressive presidents, put through Congress the Federal Reserve legislation in which it was passed, and the Federal Reserve is now the central bank of the United States. Its main branch, its Board of Governors, is in Washington, D.C. As you can see here on the East Coast, Board of Governors, and there are 12 branches of the Federal Reserve, so 12 Federal Reserve banks. The one closest to us in Indianapolis is Chicago. We're in the 7th District, which means banks get their cash currency from Chicago. They send old or worn out bills that need to be shredded to Chicago, who shreds them. They're allowed to legally. Checks are ultimately sent to the Federal Reserve, who run them through. Counterfeit money is checked and reported to the Secret Service through the Federal Reserve banks. They really do a lot of different things, and we'll get into that here in a second. But again, there are 12 of them, most of them on the East Coast, because in 1913, most of our population was in the eastern United States, east of the Mississippi. So, they provide financial services. Again, they provide cash to banks. They process checks. They process electric payments, like PayPal and things like that. They're the central authority for that. One of the main things that they do is they provide interest rates. So, for example, banks borrow money from the Federal Reserve, and they have to pay it back with interest to the Federal Reserve. The Federal Reserve sets the interest rate. Now, as you learned, higher interest rates means less borrowing. You know, if banks have to pay higher interest rates to the Federal Reserve, they're going to charge their customers higher interest rates for mortgages, homes, for college loans, for business loans. Fewer people are then going to borrow money, less economic activity. So typically, for example, we're in the middle of probably what's going to be a recession. And so the Federal Reserve dropped interest rates to almost zero, which means they're trying to get a lot of people to borrow money. Banks can borrow money from the Federal Reserve very cheap, and they can offer it to their customers very cheap. Therefore, hopefully stimulating more cash going into the economy so it flows around the economy. Remember the circular flow chart we talked about a couple months ago. When the economy is doing really well, when there's a risk of inflation, when too much money is going into the economy, they can then raise interest rates. Which means that then, the economy is getting a little too large, a little too hefty, so they thin it out a little bit by taking some of the money out by higher interest rates. And they actually have a couple other tools as well that they can use. We'll talk about that in Standard 7. But going through this list of things the Federal Reserve does, they do shred old and worn out bills, like I said. B, they do not loan money to average people or just individual people. They lend money to banks, who then lend it to people. They do supervise banks by requiring them to keep a fraction. We talked about that already. They do not supervise banks by electing their presidents and board members. Individual banks do that themselves, like PNC, BMO, Farmers Credit Union. They do facilitate the circulation of new bills in the economy, so they actually are responsible for putting more money, literal physical money, into the economy, or offering it electronically. So they cause inflation or can decrease deflation based on how much money they put into the economy. They do conduct monetary policy, which is what I just talked about. That's the idea of either putting more money in the economy or taking money out or raising or lowering interest rates. That's called monetary policy. They do not prosecute people who have made counterfeit money. Again, they can identify it, but then they turn it over to the Department of Justice, more specifically the Secret Service. And then elect a board to create new designs for money. That is not true. That is the U.S. Mint that does that. So at this point, hopefully you have watched the videos, gone over the short PowerPoint, and you are ready for the challenge questions. These personal finance notes we'll do probably next class, but anyway, good luck with the challenge questions, and I look forward to reading your answers.